Well, it was another sloppy session with all the major indices and oil closing lower while gold and bonds edged higher. Late in the session, President Trump lamented that the U.S. dollar was, quote, getting too strong, sending the U.S. dollar index, the DXY, plunging. Now, the DXY had already been making a series of lower highs and lows since peaking back on December 12th, but it's come a long way since trading under 75 back in 2011. A cheaper dollar, of course, would make the president happy. It also would bolster the bottom lines of multinational corporations. And on that note, President Trump, well, he's decided not to label China a currency manipulator, which tamps down some of the friction between our nations, perhaps even making a trade compromise even easier. Now, the big move of the session was the plunge in the price of iron ore, closing at $68 a ton. Iron ore lost more than $6 or 8.5%. This is the biggest one-day decline since March of 2014. Keep in mind, though, it's coming off of a whirlwind rally that began in November. It peaked almost at 95 in February, so it's been free-falling more than 28%. What's scary, it's happened in the blink of an eye. But before you become too hysterical, we need to look at the bigger picture, which puts this current pullback into perspective. Remember, the all-time high is $191 a ton, and that was only back in February 2011. So it's a long way from being overbought. Still, of course, it's been a roller coaster, and that mirrors the global economy, all the turmoil, all the different narratives. Today, the scuttlebutt was that high inventory levels and slowing China demand is hurting it. But you could also argue that the notion of strong demand via that trillion-dollar infrastructure plan, that might be fading and putting pressure as well. As for the Dow, will it move less than 0.1% up or down for the past 4 sessions? And that's an ominous sign. According to our guy here, Charlie Brady, the last time this happened, the last 2 times, was in 2014 and 1994. And within a month, both times, the index suffered a 5% hit. On that note, I'm not in panic mode, but many folks are now asking me about a hedge. I would focus on pullbacks in a Russell 2000, which has been the biggest post-election winner. If the Trump economic agenda is derailed or somehow delayed, the multinational stocks become more attractive. The small domestic names could take a big hit. The Pro Shares Ultra Pro Short for Russell, SRTY, will give you some insurance there. Tomorrow, we'll get a better idea, of course, of the nation's economic circumstances when several major banks are reporting. You've got Citi, Wells Fargo, JP Morgan, and PNC Bank. So brace yourselves.